My name's Paul Terry. I work in the events department at CRU. It's my pleasure to welcome you here this morning. We're delighted to be starting with our price risk management workshop, which over the next 2 hours you'll hear a range of perspectives from companies involved in hedging their price risk and from companies who will provide insight from a financial markets perspective. The workshop will include a number of presentations, and also there'll be plenty of time for debate as well. Please save your questions during the presentations so that we can focus on those during the question and answer session. We'd like to thank Gulf Extrusions for their sponsorship of the workshop. Gulfex are represented today by Raj Navasaria, who's the group's Chief Financial Officer. Raj will also be delivering the keynote presentation as well as moderating today's workshop. It's my pleasure to welcome Raj now, so please join me in welcoming him.
Good morning, ladies and gentlemen. A warm welcome to all the guests here for attending this conference. Today, we're going to have a 2-hour risk workshop, which is going to consist of 3 presentations. We have on stage quite a wealth of information from the industry. My guess is we probably have about 150 years of industry experience on the stage, which gives you guys a wealth of opportunity gives you an opportunity to ask an awful lot of questions regarding risk management and commodity pricing and so on. So please take the opportunity and let's make this as interactive as possible. So I want to talk about risk management in general for downstream industries. Feel free to note down any points you may want to clarify later on. We can take an opportunity if we have time after the presentation, or take it at the Q&A session around about 11. Because let me tell you a bit about metals industries and how Gulf Extrusions and the rest of the organization fits under metals industries. Metals industries is part of the Algeria Group. Algeria Group is one of the renowned family businesses in the UAE. It has 3 lines of business. One is petrochemicals. So the polyfilm business is probably number 3 or number 4 globally. Taglif Industries is the trademark that they work under. It has facilities worldwide. The second line of business is retail and real estate. So the iconic Burj-Aman shopping mall, the Reef Mall, belongs to the Algeria business. They also have many real estate businesses under their portfolio. The third line of business is metals. And metals industries was established in 2012 to look after the metals portfolio, part of the Algeria Group. And under metals industries, we have 2 operating business units. Gulf Extrusions, which has been established since 1976, has been operating in Jebel Ali, next to the Dibal smelter. It currently produces roughly 50,000 tons a year of capacity. It has markets worldwide. It also doesn't focus on one sector alone, which has been quite a risk for other extruders in this part of the world. Gulf Extrusion has roughly 60-65% of its volumes sold into the construction market, architectural buildings and construction. The remainder is split between transportation and automotive and industrial products. REFCO is the other operating unit. Again, REFCO operates in 2 locations. It operates out of Jebel Ali, the industrial area, and it has a warehousing operation in the UK. REFCO is an automotive company primarily, and it supplies into many vehicles through its customer base being mainly Webasto, BOS, and Inalfa. You will, for those who are fortunate enough to drive Range Rovers, Land Rovers, Jaguars, the sunroof guardrails would have been fabricated and machined out of the plant in Jebel Ali. And the value chain is pretty interesting. You'll have the billets produced out of EGA, profiled in Gulf Extrusions, sent over to REFCO to be fabricated and machined, anodized in Gulfex, then sent by containers into Europe, which is then distributed to the automotive trade through just-in-time deliveries. So it's a good value-add business that Algarera has spotted, and it's one of its kind in the GCC. There are two other projects which are under construction. We have, with our partners in Abu Dhabi, our partner Sanat, which is the Abu Dhabi investment company. We have a joint venture called Talix, which is located near Emal smelter. Again, it'll have a 50,000 ton capacity of extrusion profiles. It'll also have surface treatment facilities, such as powder coating, anodizing. It'll have some fabrication capacities as well. And there'll be some synergies between the two locations, which will reveal a few more value adds for the Algarera family and also for Sanat. The fourth business unit that we have is a joint venture in Qatar. It's a Metacoat, which is a powder coating facility. Its capacity will be roughly 6,000 to 8,000 tons of powder coating and liquid coating as well. Talix will go on stream later on this year. The cast house will come along in the third quarter, and the extrusion presses will kick off in the fourth quarter of this year. Metacoat will start to produce and commission later on this year as well. So that's a bit about the metals industries portfolio. We don't see ourselves as just a metal provider. We see ourselves as a provider of aluminium solutions through R&D and engineering solutions. We work very closely with our customers to provide solutions, alternative solutions. We also work very closely with research centers to look at new alloys. We work very closely with Duval as well. We work very closely with internally in assessing solutions and engineering solutions. Over the last couple of years, there's some new products which we've developed. One keynote product was the FireX fire door, which achieved record standards 90 minutes before having any impacts on the fire. Normally it's 30 minutes, so the 90-minute solution provides us with more opportunities to create value within the organization. So as I mentioned before, we have facilities which will add value just to profiles. So we'll surface treat our profiles for our customers. We will fabricate and machine our profiles. And across each value chain, we add value. The more value we can add, the better it is for the UAE economy. We don't want to export mill-finished products, which is another form of exporting just gas or oil in a form of metal. We want to create actually jobs and opportunities in the UAE to move away from oil-based economies. Okay, so that's enough about metals. Let's talk about risk. We have, for sure, aluminium price, which is a commodity price. Its price is set in the second ring of the LME, and I'm sure Oscar will talk a bit more about that later on. So we have volatility on the prices. The prices move on a regular basis. The price quoted now will not be the same as the price quoted in a few minutes' time. So there's volatility in the market. The price is not set by the producers. It's set by the market conditions, supply, demand, warehousing, etc. There's also a futures market in aluminium, as there is in copper and so on. So the chart at the bottom shows the forward curve as it was a week and a half ago when the presentation was put together. So the price today, at that time, was around about 1,800. The price in 10 years' time was, on that spot basis, was about 2,300. So we can go to the market and buy or sell forward based on the forward curve. When you have these two components, we can do something on price risk management. If you look at the average prices for aluminium over the last, since 2000, the average price is around about 1850. If you go back to the average price from 1980, it was around about 1650. So there is a change in the fundamentals. From my point of view, the big changes come through from warehousing of metal. So not having the metal in the market, but having it stored in warehouses, which pushes the prices up. It also has a big impact on premiums. And we'll come on that a bit later on throughout the workshop. There's also volatility on exchange rates. An example of the US dollar-euro exchange rate. As you can see, it's been pretty hectic over the last year or so. Euros have hit highs of 1.45 to the dollar and as low as 1.02 to the dollar. So it's another area of risk which we have to manage in our business. The GCC is quite fortunate to have its currencies pegged to the dollar. But once you get outside of the GCC, sell into Europe, into India, into Africa, we have a price risk issue on currency as well. So what do we need to do as a business? How do we manage our risk? How do we identify our risk? For me, there's three components to the risk. We have operational risk. It's not very clear, I don't think, but the yellow circle along here is the operational risk. Here, the risk is on your purchase of raw materials. Your raw material prices have to be linked to the finished goods prices sold somewhere along the chain, or there's a mismatch. You have also a commercial risk. It depends on your sales contracts. If your sales contracts are long-term fixed arrangements, and you haven't fixed your purchase price accordingly, then there's a risk on profitability and cash flow. And then there's also a risk on governance and compliance. The accounting of hedges is quite strict. We don't want to have situations where we had in the past with like the likes of Enron. We need to make sure we have proper accounting procedures and policies in place, a proper accounting in place. We need to make sure our auditors are on board with what we're doing. So those are the three elements of risk that we need to manage, and from a governance point of view. So commodity is as we mentioned before, is a huge impact on price risk for producers and consumers. The currency, if you're exporting outside the GCC, is another risk to our pricing. The third price risk is interest rates. We've seen LIBOR at very low rates, but that's not going to be the case. You may have long-term debt for some of your investments. Again, if you have these as floating rates, there's a risk in the future that your cash will not be as you expect. So there are instruments in place where you can also move from floating to fixed. So those are the three areas of risk which a business has to take care of. There's also complexity in the risks that we manage as a aluminium business. As the value chain moves further along, the complexity of risk also increases. For an upstream producer, the risk is on alumina and the end product, which is either remelt ingot, billet, slab, etc. The risks are confined to those prices. More or less, you could fix your alumina on a per LME basis and try and manage your sales and minimize that risk to maybe 50%. You'll find many of the upstream producers are open to taking the risks. They will not hedge their production. I know for sure many of some of the big producers, their shareholders like to keep their positions open. They want to try and beat the market through shareholding. So try and beat the upside and downside cycles accordingly. As you get further downstream, the risks become a bit more complex. You have the risk for the raw materials, which may not be on a back-to-back basis with your pricing arrangements. There could be some time lags between procuring your raw materials to actually delivering the material. And as you get further downstream and get into businesses like Refco, which is selling to automotive, here you could have fixed price arrangements with no offtake for the life of the car cycle, which could be 5 to 7 years. So trying to manage that risk becomes a bit more complex. If you're selling into Europe, you're not going to know what the currency is going to move, how it's going to move over the next 7 years. let alone knowing how it's going to move this afternoon. So this is something which we have to take care of, is to look at the complexity as we move along the value chain. Now, how do we assess risk? It's quite simple. We look at the event of risk that we want to manage, to identify the event. We then look at the likelihood of that risk from happening. Medium, high, low, ABC, 1, 2, 3, whatever you fancy. You then look at the consequence of that risk happening. The product of these two events, likelihood and consequence, will give you your severity of the risk. So if you have a high likelihood and a high consequence, it's going to be a critical risk for you to look at and mitigate. So this is something which I think when we focus on risk assessment, this exercise has to take place for the events that you've identified. So we define the event, the risk. We evaluate the risk based on the likelihood and consequence. We analyze the outcome of that risk to come up with some mitigation strategies. Not just one mitigation strategy, there could be several which have to happen. And then we go and implement the mitigation strategies. And this is not static, it's got to be dynamic. No, risks change each day. This morning I noticed my fountain pen was out of ink. I was wearing a white shirt. There's a risk there. That risk wasn't there yesterday. My fountain pen was full. So we have to be dynamic in our risk assessment and management. We can't just say, okay, the risk has been evaluated and we'll now move on and continue. We have to, on a regular basis, go and revisit our risks. Business changes, market conditions changes, so we have to be dynamic. Okay, so basically we need to understand our risk appetite. There are occasions where we will accept the risk. Maybe it's a low, medium risk, which doesn't need much attention. And we're going to take risks. For example, on your insurance, like you could take a deductible of a certain percentage, and you accept that risk. And you manage the other risks through insurance policies. In the same way, you can do the same with other price risks as well. You may want to keep some positions open, but only to a certain extent, where you can maybe look at super profits or super losses, but you accept the risks. We need to make sure our internal policies and procedures are updated so everybody is on board as to what needs to happen. There has to be a lot of awareness and training on risk management, so people, when they are making decisions, writing contracts, they look at the risks associated with those events. And we have to also educate our stakeholders. Stakeholders being our shareholders, our boards, our suppliers, our customers. And it's good to see that many of our customers and suppliers are in the room here. And this, I think, is part and parcel of the process that we're going to go through over the next short while to educate people on risk management and how things should develop and happen. Okay, so for every risk, there's an impact. So we talked about the commodity price volatility. These days, we're seeing volatility of up to $50, $100 a ton movement in a short space of time. Back in the 70s and 80s, if you saw a movement of $10 a ton, we'd think the earth had moved. So times are changing, times have changed. The exchange rate movement is also more volatile these days. It depends on which currency is worse than the other one as regards to the economy. Some bad news in the States will boost the euro. Bad news in Europe will then go the other way. So it's where the conditions are the least worst, I think, is making the currency move. Your timing of purchase and sales is also very important. We need to make sure that if you're selling on a back-to-back basis, your purchase and your sale price has the same LME or premium content in there. The quantity has to be matched up as well. So you're not buying too much of raw materials and then having that sitting in stock. As the prices go down or go up, then there's an impact on product margins and so on. So as I said, the impact is on profit margins, its impact on raw material management. If we don't order the right raw materials, the right alloys, then we're going to have the wrong materials in stock. We're going to be holding stock, or we will have maybe some stock which is required but not there. And that all gives us cash uncertainty. And if you look at our business valuations, it's based on future cash flows. Our shareholders want to understand what cash flows are, what the business is worth. And we need to look at our full business potential, which means minimizing the cash uncertainty. So why manage risk? We have to manage risk to lock in our profit margins. We want to make sure we deliver to our shareholders a profit margin which is acceptable to them. Otherwise, they will not invest in your business. Metals industries, as an example, is a growing part of our career. Now, over the next 3 years, there's a strategy to get Talix and Metacoat operational and stable, and look at the full business potential of the current operating units, Gulfex and Revco. For that, we'll need cash certainty. We need to lock in our profit margins. We don't want to be going into the market looking for debt whilst we can secure some cash margins, uncertainty in our business. We also want to avoid inventory losses on a regular basis. We want to make sure that our raw materials are matched up with our selling conditions. We don't want to be holding stocks or not having stocks in place when the customer needs them, which then allows also for commercial flexibility. We need to have our commercial team able to sell the products that the market requires at the right price. And if we can manage these risks and conditions, we will then achieve a better control, a better discipline, and increase the certainty of the business going forward. The last thing we want is to have an uncertain business. I don't want to go to my board at the next board meeting and try and explain to them that we have no certainty in the business. I have to deliver a budget. I have to deliver commitments. And by putting these risk mitigation plans in place, looking at our risk assessment, gives us that discipline and certainty. And it gives you a sustainable business as well in the long run. So my view is that we should always aim for a zero-based exposure, and we shouldn't speculate. This chart is probably very difficult to read, but it more or less covers what I said before. So we have a futures market, which is a proxy for physical business, so we can go out and buy or sell forward our commitments, which allows us to fix a price, which allows us then to lock in our profit margins, which allows us to get cash certainty as well, assuming the customer pays. We look at that on the commodity side, and we also look at the forward exchange rates as well. Again, on the forex side, we have two equations, two lines. We have currency coming in and currency going out. And so we don't want to be forward selling or forward buying gross positions. We need to understand what our net positions are and look at that exposure and manage that exposure risk. So the important thing is that there are facilities available in the market for us to manage these risks. To manage the risk, what should we have? Well, firstly, we must have a must-take agreement. If we have a long-term agreement, a 12-month agreement with a customer, which is only a price-fixing arrangement with no off-take, that's not managing. We can't manage that risk. We could book a quantity forward, which the customer will not take. So it's important that we have in place a must-take arrangement. Otherwise, we're speculating that the customer is going to take the material. We need to have time-bound contracts as well. So we can't have open-ended contracts. And the pricing has to be on a back-to-back basis. This way we can either managed through our procurement of raw materials or managed through hedging programs. So for the downstream hedging, just to summarize the three types of hedging that could take place. One is on the inventory, on the priced inventory, where raw materials are purchased but not received. That is a forward purchase. We could use that forward purchase price to link to a sales contract, so we don't have a mismatch between the two. We have inventory on hand. We're not going to sell everything that's been produced. We're not going to use up all our raw materials in the day they're sent, so there's also the risk of the inventory being revalued at a different price as the market moves along. So we have to manage that risk as well. There's the pre-pricing as well, raw materials from our suppliers, and for here we have to lock in our margins on jobs that have been committed. And then there's the spot pricing arrangements. Many downstream businesses will have arrangements with their suppliers on an average pricing basis. So, for example, it could be a previous quarter average is charged the next quarter, a previous month average LME 3 months is charged the following month. We need to make sure that if we have a back-to-back arrangement with our customer, the same pricing, the same metal is used. If not, then we have to go and look at a spot pricing arrangements or do some sort of a hedging to mitigate that risk. Okay, so now what do we need to do? How do we execute these strategies? Firstly, we have to make sure our policies and procedures are in place so that people, when they are developing contracts, when they are procuring raw materials, when they are producing finished goods, they know exactly the impacts that they have on the business as regards to risk. Delivery on time is very important. If we deliver on time based on our contractual obligations, this means we're selling the right metal at the right time at the right price. If there's a delay, we have to then roll forward positions or have a risk on product margins. It could go up or down. For me, to have certainty on your profit margin is much better than having speculation. There needs to be awareness in the organization. So need to have regular briefings, debriefings, regular risk assessments to ensure every part of the organization knows that every decision that they're taking is based on a couple of things. One is on managing risk, and secondly is on value creation. You find a lot of people who miss the two just because they have to produce. Then at the end of the month, when you produce your financial results, people are scratching their heads and wonder what's happened. So value creation and risk management are key decision players in every decision that we take. To have these hedging strategies in place, we need to open up broker accounts. And this isn't an overnight job. If you think opening a bank account in Dubai is painful and stressful, try opening a broker account in the UK. It takes months to open up a broker account, and Andrew can talk about that in detail if you wish. We have to make sure from a compliance point of view, we segregate duties so we don't have one person doing the deals and then processing those deals into the ledgers as well. We need to have front offices and back offices, and if possible mid offices as well, to go through the transactions. So there's checks and balances in the system. Then we have compliance with international accounting standards, not just IFRS, but also US GAAP. And that is also not very easy. And I think this Dilbert cartoon, thanks to United Syndication, sums up how accounting works for many things on these risk events. So, it's not easy to account for these things. A lot of documentation has to be in place. We have to regularly do mark-to-market. We have to regularly unwind hedges when they're mature. We have to make prompt payments. We have to satisfy IFRS 39, I believe, in accounting. If we don't do things properly, we could end up having a lot of volatility in our P&L statements before the transaction's even matured, which then begs a lot of questions from our board and shareholders as to why is your P&L shifting up and down When you explain to them it's the mark-to-markets and there's no cash impact, they say, well, why show it in the P&L? Which then ends up saying, well, it's confusing, so let's not talk about it and let's not do it. Which then is counterproductive with your business. So we have to make sure that we have in place the full knowledge of how to account for these hedges. We have to make sure the business knows why we're accounting for the hedges and how we're accounting for them. So we then focus not on accounting, but focus on the business end of the financials, making the right decisions at the right time. I won't go through the detailed two boxes at the bottom, but there's two types of hedges we can have: fair value hedges and cash flow hedges, and both those have different accounting treatments. Okay, thank you very much for your attention. Just check the time, see whether we have time for questions. It's 10:36, so I think we're running a little bit over. Maybe we'll leave the questions for the Q&A, if that's okay. Yeah? Okay, so next, let me introduce you to Oscar Waite, who is from the LME, London Metal Exchange. He's the head of product development, and Oscar's managing the new product development and other strategic business development initiatives taken by the exchange, including the new aluminium premium contracts, which is going to be quite an interesting discussion, I think, going forward. Oscar joined the LME in October 2013, and previously worked in institutions such as UBS, where he was advising banks and insurance companies on exchanges on mergers, acquisitions, and capital raising transactions. He started his career in the financial services practice of management consulting firm Oliver Wyman. So let me welcome Oscar to the podium, and he can talk about the LME and so on.
Thank you very much, Raj. Okay. So the LME was founded in 1877 as a response because buyers of metal, of copper and tin, so copper from Chile and tin from Malaysia, wanted price certainty. So they agreed to buy metal. It was put on ships. It took 90 days for these ships to go from Malaysia and Chile to London. And they wanted to set the price immediately when they knew that the ships departed. And they knew this because of the new invention, the telegraph, back in 1877. And that's the heritage of the LME. And the 3-month period is something we still see today on the exchange, because the 3-month contract is our most liquid contract. The LME was acquired by the Hong Kong Exchange in December 2012. And then to move on. So we started obviously then with copper and tin. In aluminium, it's noteworthy to point out that our primary aluminium contract was launched in 1978. Then we added aluminium alloy in 1992, NASDAQ in 2002. And later this year, we're looking to launch the new aluminium premium contracts. And next slide looks a bit at LME volumes. So the LME represents about 80% of global exchange-traded base metals. And that represents nearly $15 trillion of notional value, so value of metal, or 4 billion tons of metal. So large quantities. Here we can see a chart showing our aluminium price and the stock levels. And what's really interesting to see is what happened in 2008 when the financial crisis hit. So obviously, financial crisis, demand for aluminium plummeted. What happened to the price? It also plummeted. And what happened then to aluminium producers? Because it takes so long time to restart a smelter and it's so costly, the aluminium producers continued to produce, but when their buyers weren't there to buy the metal, the LME was there providing a market of last resort, and they delivered their metal into LME warehouses. And that's why we saw the stock levels going up so significantly. That caused also an effect on rising premiums in the market, especially because a few of our warehouse companies were very clever and managed to attract large quantities of metal, unfortunately resulting in queues. And these queues were then an important driver behind the premiums. But with the recent warehouse reforms that we've introduced over the course of last year and this year, we're seeing the premiums starting to go down. So what does the LME actually do? The way I think of it is that the LME has three different purposes. It's pricing, providing a global reference price for the market. It's providing a venue for hedging, and it's also providing a market for delivery of metal through our warehouse network, our licensed warehouses. And the warehouse network is very good for providing sort of convergence between the physical and the financial market. And then I will also talk a bit about hedging. First of all, why is it good to have an exchange-traded price as your foundation? It's because it's a daily price, it's transparent, it's discovered in our ring, which you saw a picture on in the first page. We also have an electronic trading platform and a telephone market. It's heavily regulated, and that means it's a very robust price and trusted price by the market. And these prices are available in real time. And the LME price represents metal in an LME-approved warehouse of an LME-registered brand. It's duty unpaid, so there's no taxes or VAT, etc. So it's neutral across all different countries, all different tax regimes. And then, as a buyer, you are responsible to pay for the cost of getting your metal out of a warehouse. So that is what the LME price represents. And the LME price is relevant wherever you sit across the metal value chain. So if you look at semi-fabricated products like ingot and billet or cathodes, that is what the LME price itself represents. But if you're earlier in the value chain, you have the LME price less a discount. And later on, you have the LME price plus a premium representing your production cost or profit margins, etc. And how does the physical market use the LME prices? So metal consumers and producers, they use the LME prices as a reference point for their physical transactions. So you start with the LME price, often with the average daily price over, say, last month for the transactions you do this month. So your LME price is the start. And then you adjust this, plus and minus, depending on where you sit in the value chain, what the grade is of the metal that you are buying or selling versus the LME requirements, the LME standards. Then there are also differences between premiums, so maybe, or different brands. So you maybe have a specific brand that works better in your production. So then you might make an adjustment for that. You also have differences in locations. So if you want to have your metal in a non-LME location, then there's an adjustment. Differences in how the metal is packaged or delivered. The transportation to the consumer, that's also built into the LME price. You have differences in timing and then also maybe volume, discounts, or premiums, and then the aluminium premium, which I'll come on to later and explain. But that is basically the principle behind how the physical prices are used, the physical sale prices. And when we talk to people in the market, we hear a lot of comments about why people don't hedge. So for example, people say that hedging is speculation, or they say that hedging is complicated. They might say that it's very expensive, or that the shareholders want exposure to the metal price, and that's why they shouldn't hedge. But if a shareholder wants exposure to the metal price, they can trade in the metal, not in the metal producing company. So as Raj has already mentioned these points, but I think they're very important, and that's why I'm going to say them again. So the purpose of hedging is to establish a position in a futures or forward market on the LME, which is equal to your risk on the physical side. So you have a physical risk exposure, and then you offset this with an equal financial exposure. That allows you to obtain three key purposes. It protects you against volatility and uncertain price movements. You can lock in your profit margin, and it also helps you to protect your inventory value. So if you have inventory in stock, price goes down, the hedge then offsets the loss on your inventory. Raj also showed the information on this chart, but I think when you add them together, it gives you a pretty interesting message. So historically, the price of aluminium has been very volatile. And high volatility is obviously high risk for anyone in the aluminium industry. But the LME forward curve gives you a price today out to 10 years in the future. So that means you can have certainty today about what the price that you will achieve on transactions you make today, based on information you have today. Now I'll come on to the recent reforms that we've done at the LME. So as you saw previously, the stock levels grew significantly in 2008, 2009. That caused significant queues and also was an important driver behind the aluminium premiums. So to address this situation, we introduced in 2013 a significant consultation period with the market, where we proposed a new fundamental concept, which is a linked load-in, load-out rule. So basically trying to make the warehouse network as elastic on the way in as it is on the way out. So basically, you can have stock levels increasing rapidly, and then you can also have stock levels decreasing rapidly when the market needs the metal. So the key point was the linked load-in, load-out rule, or the LILO rule, which unfortunately we had some problems with this rule because of the UK judicial review, but we won in the end and were able to introduce this rule in February earlier this year. Last year, we introduced 6 different measures. So to increase the transparency in the warehouse network and across the LME, we introduced a commitment of traders report. We also started publishing what the warehouse queue was for each individual warehouse that we have. We introduced a separate load-out rate for steel. Steel was also caught up in the LME, in the aluminium queues, and steel is loaded out using different equipment. So it makes sense to have a separate load-out rate for steel. We introduced strengthened our information barrier policies, and these are to prevent situations where you have a group structure with a trading company and a warehouse company, and preventing the trading company to take advantage of information in the warehouse company. We don't think that we can stop warehouse companies and trading companies from sitting within the same group and fine, they can give discounts to each other, but they can't share information about what's happening in stock movements in the warehouse to the trading company. And that's what we've stopped with this information barrier policy. We also introduced a very general power for the LME to prevent creation of artificial queues. And then we also introduced a physical markets committee, which is sort of overlooking the entire physical market. So previously we had a warehousing committee, and then the different metal committees, but no one really had a wider view with representation from across the market on the physical market. So that's what we also introduced last year. And the next round of reforms as part of the broader reform package were announced that the decisions were announced in March this year, and they will shortly be implemented. So it's the legal review about the LME warehouse agreement, a lot of boring legal details, but an important element here is around the LME getting more information about incentives that are being paid by warehouses, so we can prevent unfair incentives being used to artificially create queues. Then we also have the logistical review. The key point here was to define what is actually load out from a warehouse, because we want to prevent so-called merry-go-round transactions where metal is just being moved from within the same company, moved from an LME warehouse to off LME, and this still would count previously towards loadout. Now you need to have a bill of lading. It needs to leave the warehouse, either go to the same warehouse company but in a different location, or to another warehouse company within the same location, or obviously to the consumer. Then we also have the premium contracts. So from a warehousing perspective, it was rules to support prompt delivery of premium metal. Then the final 2 points are sort of future policy options that we have. We published earlier this year a discussion paper where we engaged with the market to get the market's comments and feedback. This discussion period ended in early May, and we will shortly make an announcement. But the 2 elements of this is basically a charge capping mechanism, which would look at see if the LME would be able to cap the charges that the warehouses apply. And then also look at if we would be able to limit or cap the rent that you have to pay while your metal is being queued, so while it sits in the queue before it can be delivered out. So you'll shortly have more information about those 2 potential options. And now we come to the premium contracts. So the way we think about the aluminium premiums is that there are basically 2 main drivers behind the premiums. So you have the queue situation. It's important, but it's not the only driver. And as the queues go down under the LME warehouse reforms, the queue-driven element of the premium will decrease. But then you have other important factors behind the premiums. And these are basically market supply and demand factors. So you have different demand in different locations. You have different demand for different shapes, brands, and qualities. And those are things that also go into what I talked about previously when you derive the final price for your physical transaction. Then you also have a difference in the FOT, or delivery out charge, that the warehouses apply. So these differ from warehouse to warehouse. So what the premium contract will deliver is a mechanism for the market to hedge the all-in price of readily available aluminium in the region where you need the metal. And the way the premium contract will work is that you have 4 different regions that the contracts will cover. So you have a US premium contract, you have a European premium contract, and then you have 2 Asian contracts, one Southeast Asia, around Malaysia and Singapore, and then one East Asia contract, mainly focused around Japan. These will allow you to hedge the all-in price of readily available aluminium. You will get physical delivery, or you can get physical delivery if you hold the contract until expiry of metal that sits in a premium warehouse. So a premium warehouse is a warehouse that doesn't have a queue. We will have warehouses signing up to stricter load-out requirements, guaranteeing that the metal will be delivered out quickly. And the longest potential queue you could have under these rules is 34 business days. But if a queue forms, the warehouse will not be able to create additional premium warrants until they've removed the queue, then they can start again. And another important factor for the premium contracts is that these will be monthly contracts, and that is to concentrate all the liquidity. Rather than spreading the liquidity out across some 20, 22 business days over a month, we'll concentrate all that liquidity into 1 day per month, the 3rd Wednesday, and that will help the market to get, it will just be easier to trade these contracts. It's going to be easier to get into the contract because you have more liquidity. And then if you want to use the contract as a financial hedge and close out your position before you get to delivery, then it will also be easier for you to get out of the position. And on this page, I'm trying to illustrate how it will actually work with the new premium contracts once these have come into place later this year. So on the left-hand side, we see that at the moment, if you buy aluminium, you pay something like $1,900. Then you will get an LME warrant. This warrant is likely to be in one of the queued warehouses because the seller has the option of deliver any warrant he wants within the entire network. So he will deliver, naturally, the least expensive warrant. And these are likely to be in Detroit or in Bissingen. But with the premium contract, what you do is that you trade 2 contracts. So you trade the standard contract, same thing as on the left-hand side, but in addition, you also trade the premium contract. And the premium contract basically upgrades you from a standard warrant to a premium warrant. So whatever the premium that you've agreed on, the premium I have here, the 320, that was the Midwest premium in the US from last week. But that means all in all, you may be paying something like $2,200, and then you will get a premium warrant which is readily available for load out in the region where you want to have the metal. And I think the mechanism of having an exchange-discovered premium price will be very important for the market from a transparency perspective. That's what I wanted to cover. So suggest we move over to the next person. But I have a big appendix, which I think we'll skip through. Here we go.
Thank you, Oscar.
Thanks.
Let me introduce you to David Waite. David is from CRU Associates. He spent over 50 years in the commodity business. There's a whole wealth of experience just sitting right there next to Oscar. He was educated in England at the Magdalen College in Oxford and began his career at Noranda Sales Corporation in London and Toronto. In various metals and concentrates marketing roles from 64 to 72. He moved to Noranda's associate, Rudolf Wolf, a founding member of the London Metal Exchange, to head up its physical division. He then moved to New York to start up Wolf's US brokerage subsidiary in 1977. From 78 to 1990, he has with the investment banking house Drexel Burnham in New York as senior vice president responsible for the US metals and energy futures, brokerage and finance group. And from 1990 to 1930, he was the managing director at Wall Street House Payne Weber, heading up its commodity and foreign exchange division in London and New York. In 1993, he went back to Rudolf Wolf as Director of Business Development, operating out of both New York and London offices. In 2000, he set up the Commodity Risk Management Associates, and this is his personal vehicle for providing advice on commodities to industrial clients, and has been running the CRMA since then, providing risk management services to a roster of leading global metal companies. David, the stage is yours. Thank you.
Good morning. I'd like to just, by way of introduction, focus on the downstream aspect of this. My presentation is intended to be very focused on the practical aspects of hedging and risk management that industrial companies find themselves faced with. And the concept of the downstream industry, without pushing the analogy too far, the analogy of a stream, you basically have two types of situations. One is where you're allowing this stream of commodity prices to pass through you. You acquire it at one time and you pass it on to the next buyer at another time, and your job is to hedge the risk that occurs in between. And that's sort of like the river as it flows down. Eventually the river reaches the sea, and it reaches this massive pool of consumer demand. And if you're an end user, an automobile manufacturer or an aerospace manufacturer, producer of beverage cans, a builder of buildings, almost any of those which use aluminium, you're an end user. And so you're not a pass-through candidate. You basically accept the final risk of this commodity before you turn it into a consumer product. And that's one kind of way of looking at the industry. The other thing is that you have to look at the way you manage this stream as if it's two businesses in one. The business of manufacturing, producing, keeping clients satisfied, engineering, product matching, supply chain, all of that kind of thing, which is the standard business management of more or less every industry that we face. And then secondly, you're managing this commodity stream, which is a very different kind of a business. And this commodity stream, which varies from anything to a slowly moving snake to a violently rampant tiger, depending on the status of the market, is something that you have to live with as part of your business. And I know it's not easy. It's been a matter of decades of the industries finding a way to handle this problem, but the bigger problem is that you can't ignore it. If you try and ignore the fact that you have a commodity, an aluminium risk in your business, and above all, if you do nothing about it, this is the worst kind of speculative trap you can fall into, far worse than speculating with your hedge book. So the issue is, for everybody in this room, this is not something, it's not a risk you can avoid. So it's well worth paying a fair amount of attention, not just to me, but to the problem. Just a quick word about CRMA-CRCI, which is a relatively recent one-year-old alliance between myself and Mike Lockwood, and we've both spent our most recent careers providing commodity guidance to industrial companies. I've had in this region have helped companies such as Garmco, Dubal, Ducab, Oman Arc, SABIC, just to name the ones in the region, in the aluminum industry. Elsewhere, Novelis, Constellium, Alludium, again just in aluminum, several others in other metals. And Mike has spent the last 20 years of his career in Noranda, Falconbridge, Xstrata, and Glencore, actually managing risk books, copper and zinc mostly, risk books for those processors of metal. So we have a considerable amount of practical experience in these issues under our belts. Just to review my part of the program, I'm going to be talking about hedge instruments, first of all, then a brief foray into the use of options, again in the industry somewhat limited as against in the worldwide market as a whole, and lastly, but probably most important of all, the administration of these risks. You'll hear me say several times during the presentation that hedging is easy. It's managing the details that's difficult. And above all, what's difficult is matching the uncertainties of the commercial world to the relatively deadpan, straightforward world of hedging. And so the administration and the management of the risk as you combine those two streams is the real trick in becoming a successful risk manager. So I've devoted quite a bit of time to talking about that. In terms of the types of hedge that you can use in a risk management program, focusing mostly here on the commercial aspects that are most common in the industry. And frankly, the pass-through model is by far the most common and the largest volume in the industry. There are examples of companies, downstream companies like, say, General Motors, for instance, which once had a hedge program of over 1 million tons and a duration of up to 10 years forward. And that was obviously a very significant part at the time of the world's hedges. But if you look at the volume that changes hands in a hedging sense on, let's say, the LME, which is the primary hedging vehicle for aluminium, as indeed for all other metals, the vast majority of the volume is actually through pass-through, people who are fabricators downstream, who take the risk that they acquire from their producer and pass it on to their client and have to hedge the period while they're holding it in between. So the focus of this is very definitely going to be on the risk avoidance aspect of hedging. And we have finally become truly prisoners of our accounting colleagues here, since accounting is the mechanism by which risk is seen and is analyzed. The way that we now have to think of things is very similar to the way that accountants think of things. And so what we fall into two categories which the accountants have defined for us. And one is the cash flow hedge, which is essentially focused on making sure that the same amount of money is coming in from your metal as you're paying out for your metal. Forget about the valuations of where it may be in your company's accounts, but just simply the cash flow. And this is obviously the factor which, if you don't manage it properly, you'll go bankrupt. And so the fact of a few people not managing it and going bankrupt has created the disciplines that are required in cash flow hedging. I've shown, I'm not sure if you can see it, probably not, but you'll get a chance to look at it afterwards, an example of a typical cash flow hedge, which is, in the way that the industries operate, mostly customers buy from you before you buy your raw materials. So in this case, you're actually hedging the sale part of your transaction first, and then the purchase part of your transaction later on, when the long-term supply contract, which will supply the metal for your sale, is priced. And the most important thing to sort of figure out first is that this is the philosophy of pricing and hedging in the manufacturing of metal products, is that you're looking to cover the replacement cost of your raw materials. If you sell product in May to a customer and it's priced and you hedge it, and you acquire the raw materials which to supply that sale arrive in May and they're priced at the same time, the cash flow that you're hedging is essentially the cash flow between the sales revenue and the replacement raw materials. The inventory doesn't matter when it comes to cash flow. So the preeminent way that you look at your hedges is a cash flow hedge for hedging the sales revenue against the cost of raw materials. A secondary aspect of hedging is the fair value hedge, where as an asset which you hold, your inventory is going to be subject to accounting rules, particularly the lower of cost of market rule, which in a volatile commodity market, and giving the famous example of 2008 when the price dropped from whatever it was, $3,500, I guess, in the middle of the year, down to $1,300, and the value of inventories that was wiped off a world of manufacturers was a key element in losses, financial losses that companies had to take. They weren't necessarily cash losses if they were able to offset their inflow and their outflow, but the value of those inventories drops sharply. And as a result, there is a separate kind of hedging, which is called fair value hedging of the inventory asset, where companies simply hedge the value of their asset against declining prices of the commodity. The detail, I won't go over the details of each of these types of transaction. It's a lot of ground to cover, and I think the most important thing is to cover the highlights. And if anybody has any questions about the details afterwards, I'll be happy to answer them. Okay, instruments. Again, this is a bit technical, but there are several types of instruments you can use for hedging, and the most important sort of determines what type you use is depending on the type of goals that you have. Typically speaking, people manage the supply chain flow and the sales flow separately because there's no correspondence between them necessarily until the point that they meet in your plant and one produces the other. The volumes could be different monthly quantities. Supply chain may be a regular supply chain. The sales may fluctuate. The fact is that you need a separate instrument to hedge the purchases and hedge the sales. And that's what the futures or forward instrument does. It simply allows you to hedge a purchase for a settlement date, and then when the sale comes up, to hedge the sale for the settlement date, and the two match between them. If you have a goal where you say, I don't care about the fluctuations in my supply chain, let's say, I'm just going to hedge the sales, then you can use what's called a swap, which is where the two transactions are melded together in one. And when a customer prices with you for a forward month, you will buy a swap transaction for that month, which will automatically be liquidated at the average LME price for that month. You have both sides of the sale and the supply chain hedge taking place, but if the supply chain volume is different from your hedge volume, you're ignoring that. Obviously, it's not as precise a hedge, and in fact, my advice has been to, and most, I believe, fabricators now use futures or forwards combined together with carries when there is a mismatch between the two as the way of the standard way of hedging. Options. Futures and swaps are simple buys and sells, just as your purchase of raw materials and sale to a customer are simple buys and sells. But an option gives you the right to buy or sell without suffering the adverse consequences of that. Effectively, you can decide to buy at a price that's an attractive price or is a price that you've sold at, and then when the time comes up that you have to settle for that, if that price transaction isn't making any money or is losing money, you can abandon it. And if it is making money, you can take it as a hedge, which is obviously a very nice possibility to have. You're always right, there's never any loss, but of course along with that goes a cost, which is the cost of the premium that you have to pay. So that's a very distinct type of hedging than the swaps or the futures or forwards. Fixed versus floating is a bit of sort of techno speak here. In the industry, you will either buy or sell raw materials and product on the basis of a fixed price, which corresponds with a price that trades on the LME at any point in the 24-hour trading day, or as an average, probably a monthly average of the LME cash settlement price. And so the fixed is the fixed price and the floating is the average price. So you can basically put on a hedge for your fixed price sale, your fixed price purchase, your average price sale or your average price purchase by doing either a swap or a futures. All of these are a very comprehensive selection of ways of hedging. As I say, what determines which one you'll use is what your goals are and what the flow of your pricing, your commercial pricing is. So you see by the little diagram that I put up here, what we're trying to do is transition between a pile of commodities to a very sophisticated machine or engine at the end which uses aluminium. By the time you get to the end stage, you've lost any distinct aluminium feature of that. That engine doesn't sell or be bought at the LME average price of anything. It's sold at a price. Whereas the commodity at the top is very, very indexed to a fluctuating world commodity price. And the industries in between, the downstream industries that you're all a part of, your basic task in managing that is to manage those transitions between supplier and customer on a very similarly based indexed LME price. A lot of you will buy on the LME price and will sell on the LME price. Some of you will sell on a price which is not related to the LME, some which is related but not necessarily closely related. The hedging challenge is to match those transitions. And very simply, customer forward pricing is the sort of standard of most hedging of most fabricators against the replacement cost of raw materials. You've sold something for May delivery, the supply will be coming in from your supplier at the average May price, and you have to match the differences between those to make sure that the net result is zero. And that's essentially the purpose of an offset hedge, is to create a complete balance between the customer and the raw material price. Life's not always as simple as LME contracts, and volumes change. You may have a supply that for various production reasons is elevated at a certain point more than the sales, and then later on will perhaps drop to lower than the sales as you work off that excess inventory. That's still going to be a cash flow risk for you. If you buy at a high price that you haven't sold or hedged at, then you're going to lose money. So even if you're buying for inventory, companies will also hedge the excess inventories. Some companies hedge all of their inventories if they're concerned about the accounting implication. Excess inventory is a cash flow problem. You're buying now, selling a few months later. If you don't match the cash flow, you'll be losing money. The basic inventory, which never goes away, is a valuation issue. You may decide you want to hedge that valuation or not, but it's a different kind of a hedge. Sometimes those characteristics are basically non-discretionary hedges, where you're just trying to match the inflow, match the valuations. Other companies have what I call discretionary hedges, where if their raw material cost drops to an attractive low level, and this is again more end users, they will fix that at an attractive price. That's what General Motors did back in the 90s. Next thing is that if you have the possibility of making sales with a degree of uncertainty in the sale volume, but a certainty in the price that you've agreed to, then your only choice is to hedge that by using options. If the sale doesn't materialize, as in a tender, then you can abandon your option. And that's one fabricator use of relatively unusual. The cost of it is so expensive that most fabricators faced with tenders will go to the company and say, I'll make you an offer, a firm offer of this product, defined as you want it, but we'll fix the price the day after you accept the tender. And that avoids the risk problem as against spending a very expensive premium for it. And as a customer, as a service to customers, the first use of hedging was basically to supply what other customers who didn't hedge needed in the form of certainty of prices. And this is now going further and further down the chain. It used to be that the producer provided that to his first consumer. Now the fabricator provides it to the end user. So the service aspect of doing this is also becoming an important motive for people. Very important as a side issue to consider the cash flow implications of that. The LME, wonderful as it is as a hedging vehicle, is relentless as a contract about being paid on time for its commitments. And if you have commitments with your customers which run the risk of not being paid on time, you're running a cash flow risk. Hence the talk about take or pay agreements that we talked earlier, which you heard from earlier, which have become increasingly part of the mechanism of a hedger to make sure that their cash flow is managed. Okay, options, again, it deserves only a brief look because it is not very commonly used by downstream companies. As I mentioned, you can use an option to give you a double choice, the best of both worlds, when you make a hedge. And as a return for that, you have to pay a hefty premium, which in most cases rules them out as an offset hedge. You couldn't sell to your customer on an offset basis and build in a 10% premium into the hedge to cover yourselves. So most of the clever combinations that options tend to be offered at don't work because of the premium costs. The other aspect is that in order to avoid the premium cost, structures are created whereby you've bought an option on one side. Let's say if you're selling to someone, you buy a call option which protects you against the upside, and in order to avoid having to pay the premium, you give a put option on the downside. This is called a min-max, and the only problem with it is that if the prices drop and you don't need the protection, you have acquired aluminium at a price which was the price of your put option strike. So nothing is without cost in this world, and the min-max option is no different. If you're a fabricator, you're probably better off if you need absolutely to have option protection to just buy a straight option. The cost of premiums is quite difficult to follow. I'm not going to go into detail here, but it's basically a function of the time to expiry. Obviously, a one-year option is going to cost more than a 6-month option. It's also the closeness to the strike. This isn't quite so obvious, but if the price is now $2,000 and you buy a $2,200 call, which is a long way away from the strike, that's a lot cheaper than buying a $2,000 call option. And the last one is market volatility. If you have a market that's raging between $3,000 and $2,000, the cost of any option, whatever duration it may be, is going to be a lot more than we have the kind of markets at the moment where it's trading between $1,800 and $2,000 in dollar terms. Just one side point here. The use of options as a hedge tool may or may not be of value, but the use of options which are granted by you to someone else as a freebie are absolutely to be avoided. It's been a commonplace of the metals industry for 100 years that people have always liked to take options from people who weren't to give them. The look-back option, well, you give me an offer now and I'll let you know in a week's time whether I take it or not. Effectively, if you give me an offer now and I'll let you know in 5 minutes' time, you're taking a look-back option. You're not taking as big a risk with it, but it's still a look-back option. And in the annals of administration and control of a hedging book, it's a no-no. You should never do it. Okay. Administrative controls. Let me emphasize once again that the easy part of this is the hedge side. Hedges are homogeneous instruments very carefully designed by the LME 100 and odd years ago to be effective instruments and easy to administer, and the ability to calculate their impact on your cash flow match what you've agreed with your brokers to make sure that you both have the same calculations are relatively straightforward things to do. You have basically two options when you look at administration and control system. One is Microsoft Excel, with all its wonders and all of its problems, and the other is an off-the-shelf system which has been designed to look after the issue that you're trying to control. So I'm going to talk about both of them as we talk about administrative systems here. As you see, transactional accuracy, reconciliation, personnel, how many people does it take you to do this system? The more transactions you have, the more people you need, the more efficient it is to have a system rather than to be using an Excel system. Cash flow management, an absolutely vital part of every hedger's tool since 2008, where some people almost found themselves and some people did find themselves going bankrupt because they're not managing the cash flow of their hedge book, which will be different from the cash flow of your commercial book. And the operating cost, usually with Excel spreadsheets you create your own, it's a less of an operating cost, but when you come to evaluate all the costs of losses and slippage, reconciliation errors, cash flow, the ability to manage your business, it might not be the best way to go. It depends how risk-prone your business is. The second aspect is what I call risk management as distinct from hedging. And this means the combination of the risk that is involved in running your commercial business with the hedge side. And the commercial business presents much, much more difficult problems than the hedging business does. The fact that customers will change their mind and want to cancel contracts or delay them, or the suppliers supply more, or the customer schedules his shipments so that he actually takes less than he's committed, are just simple examples of how the variability when you combine hedges with commercial transactions, where the kinds of problems that they can create. And what you need to do to effectively manage risk rather than to just hedge is you have to combine the pricings of your commercial business, purchases and sales, with your hedge book into one combined management system. And here you reach a bit of a dichotomy. Obviously, most of you run the engineering side of your business with invoicing, deliveries, scheduling of plants, etc., through an ERP system. And ERP systems are very good at creating all of the data that you need to do those managements, but they're not very good at creating risk systems. And on the hedging side, you have systems that are designed to look after the hedge book and do all of the arcane things that broker calculations need and LME settlements need, but they don't do a very good job of managing invoicing and deliveries. So you've got to somehow combine your ERP system with a risk system if you're going to do that effectively. The ability to download from one to another becomes important. What I call slippage here, which is a generic description of all the nasty things that can happen in the physical world that don't happen in the LME hedging world. All these changes of quantities, price, the fact that the customer won't agree to a price that's hedgeable and wants it left with him for 4 hours or a day or 2 minutes. All of those elements of slippage, if you're going to manage them and make sure that you don't have a pattern developing of loss making through slippage, the only way you can achieve those results is by having a system which matches the details of the physical shipments and the physical supplies with the hedge details, and you have to have a linkage of each hedge to each order if you're going to do that. Otherwise, you'll lose the visibility altogether. And along with the ability to link all of your commercial transactions with all of your hedge transactions come two very vital aspects of managing risk. One is visibility. So many people manage a business and they know what the hedge book's doing, and they can say whether the hedge book's making a profit or what the cash flow is in the hedge book. But matching that with their physical book, which gets completely lost into cost of goods sold and revenue, they have no idea at all. And this means that if you have no visibility, you have no accountability. If you have one salesman somewhere who's perennially underquoting his customer, or if you have one customer somewhere who's perennially taking a look-back option on you, or changing the shipments when the price goes up or down, if those things are happening in your business, you won't be able to stop it, have accountability, unless you first have visibility. So this is the very important aspect of the administrative and control system that you have. And the key to the success in this is having meaningful risk reports. Cash flow we've talked about. The financial exposure from mismatched commercial prices and hedge prices. The bane of my life every time I go to a new client, the ways that they do things with their customers seem as though they're almost designed not to be hedged properly. And managing that mismatch and creating discipline amongst the commercial forces, purchasing and sales side, that will enable you to run a risk-managed book is very important. So you have to have a report that shows you when it's not matched properly. The hedge manager, the person who's actually running this hedge book will not always be running a completely neutral book. He may have to be hedging 3-ton transactions with a 25-ton hedge, which means that he'll be running a balance in his book. So you have to have a way of managing his P&L and his controls and his limits independently of what the commercial business is doing, as well as matching the combined effects. The business unit, likewise, that's doing the hedging, they are doing all the selling and they're doing all the purchasing, and they're asking the hedge manager to hedge for them. They will also be carrying an exposure. You need to be able to look at that. This is nothing that the hedge manager can do anything about. If you are persistently not matching the timing of your hedge with the timing of your sale, then it'll show up in the business's P&L, not in the hedge manager's P&L. Salesperson accountability. I'm singling out salespeople here because they're usually the ones who are most guilty of it, but the supply chain is the same, particularly if you have a lot of secondary in your business. If you have secondary supply chains, the difficulty of managing that precisely against a hedge book creates slippage too. And the ability to monitor those commercial practices, very important to have effective risk reports. And finally, the aspect that no hedge is possible without taking what we call spread risk. And that's the risk between the cash price and the forward prices that you hedge at. You have to manage that risk, and you obviously have to, if you're going to manage it successfully, you have to have the visibility on how well you're doing in contango and backwardation management. Which brings us to the issue that all new hedgers find themselves developing a hedge mentality and a hedge discipline, and immediately they have to introduce change into their commercial world, because what they do in the commercial world doesn't match what the disciplines of hedging are. So, some people still even use historic pricing, whereby they just take the cost of raw materials, add it to the value of the inventory, and that's the price that they sell at. Fine, in a rising market you'll do terrifically well. In a falling market it'll be a disaster. So you have to have replacement cost pricing. When you have replacement cost pricing, you have to have simultaneous hedging and pricing. The LME is a great instrument, but only if you can match exactly the same time that you do your buy on the LME as you're doing your sell to the customer. Look-back options, which is the subsequent of that, you can't leave. The price is the price. It changes every minute. You can't leave someone with an ability to look at your price for half an hour a day. If you do, you'll run the risk of them taking look-back options on you. Your choice when you have that situation is to manage it. You don't throw out every customer who wants to look at prices for a while. You just price in a way that you make sure you're not losing money on the transactions. Hedge charges. It's very common for people to have price lists where they assume that they're just going to be able to price at the LME price, cash settlement price of tomorrow, and they'll be able to give that price to the customer. There are actually costs in hedging. There are substantial costs in staffing a hedge desk. There are also the bid and offer spreads that you will encounter as you do the hedge. So you've got to take account of that. You've got to make sure that your customers are paying for the service that you're giving them in allowing them to hedge. Under and over shipments, we talk about delays. You've got to be able to, if you're going to be effective in risk management, you have to be able to monitor the performance of all the people who are taking the biggest of these risks, your salespeople and your supply negotiators. It's not the hedge manager who's taking the risk, it's them who's taking the biggest part of the risk, and you've got to be able to monitor how well they're doing. You need a system, you need reports to be able to do that. And if you're going to manage them, and if you're going to establish a performance, there's got to be some compensation aspect. If they do badly, they're going to have to be fired, and if they do well, they should get a bonus. This is all part of the success of running the business. So you can't do that without having good risk reports which don't allow a salesman to spend his entire year satisfying every customer and losing you a pile of money. He is going to be compensated and disciplined to make sure that there's a balance between that. And all of this obviously becomes relatively complex to manage. Most companies establish a risk committee to do it, which designates what the reports will be, what the exposures will be. They will tell the sales department what they have to do. They'll tell the purchasing department what they have to do in terms of pricing, only in terms of pricing. That's all we're talking about here. And they will establish the risk parameters, and they will look at the reports, and they will evaluate that. It's a whole sector of the business which you have to manage. You can't do it by leaving it to someone in a corner office somewhere and hope that he's doing the right job. Okay, a few examples of some risk reports here. Thanks to our friends at Brady PLC, whose hedge manager program these next few slides come from. One thing that simplifying for senior management what an exposure looks like, this is one example of many of how that can be done. You have a matrix of all of your forward pricings by delivery month and by pricing month, and all of forward hedges by delivery month and by pricing month. The idea being that the numbers at the bottom here should all be zeros. Obviously, they won't be zeros because you may be selling 3 tons and hedging 25, but in theory, they should be less than 12.5 tons. And that's a good, quick, daily system for the CEO to look and be sure that no exposures are taking place on the commercial side of his business. Underpriced orders, if you're hedging, you're not hedging an order when it's committed, you're only hedging it when it's priced. And if it's still unpriced and never gets priced, your whole management structure will be out of whack. So one way of dealing with that is that you have a regular report which shows you what of next month's shipments and the month after shipments are still unpriced, so that if you've got next month's shipments coming up and people haven't priced them, you know you're going to have a slew of pricings coming in. You know you may have to go to your salespeople and say, don't have these people delay these shipments, make them price now. So that's another tool that's used. Excuse me. Heavy thumb. Link price orders. I talked earlier on about the slippage question. Slippage can only be resolved when you have a mechanism that links the prices to the hedges. Every time you do a pricing, the hedge transaction that you do is linked to it, so you can dump all the linked transactions out. And this is a dump. This is just showing a hedge and a physical transaction together. But you can use your Excel spreadsheets and your pivot reports to filter any kind of customer, salesperson, region, profit center, whatever you like, and show how well they're doing in avoiding slippage. The slippage is the major issue that fabricators face when they're managing risk. Picking these pretty much at random, there are 100 reports that you could select. Margin utilization, if you have brokers, they will usually give you a credit line that you can run the losses on your hedge position up to, and this is a report which allows you to look at that hedge credit line that you've been given as against where the mark-to-market status of your hedges is, so you'll know where you might face the possibility of having to put up margin or moving position from one to another. Moving now from the Brady reports to just a standard pivot table report from Excel. Here is a way that you can manage daily slippage. The day after it occurs, you get a dump of all the pricings and all the shipments, and any of the mismatches between them, it becomes obvious. You go back to that salesperson, that sales office. Why did this happen? This is where the discipline starts. How you avoid the slippage means picking up, policing all the transactions. I am sure that all of you have faced situations where you knew there was a problem, but you didn't know where it was coming from. This is the way you find out where it's coming from. And going from this sort of simple and straightforward to the complex, larger organizations may have several different business units. You may have a plant in Dubai, and another one in Abu Dhabi, and another one in Oman. You don't need to have 3 hedge managers and 3 hedge systems for them. You can use one hedge system and one manager who hedges each of the transactions of each of the profit centers. And then what you'll need to do is to create a settlement report for each one, and this is a typical kind of settlement report for all of those. There are many, way too many kinds of reports to go into in detail here. Very happy to talk to you about them more in detail afterwards, if you would like to do that. And that's it for me. Thank you very much.
Thank you, Oscar. Thank you, David. Let me now introduce you to the 2 other members on the stage, on the panel. On the very end of the seating arrangements, we have Andy Evans from International FC Stone. Andy has worked 20 years for primary aluminium producer Comalco, which is now part of Rio Tinto, in a number of roles involved with their bauxite, alumina, primary metal trading, hedging, and aluminium powder sales. More recently, in the last 17 years, he's been working as an LME broker and trader, mostly with industrial customers in the aluminium industry, providing hedging, hedge strategy, market information services. He's been a regular visitor to the Middle East since 2002, and the reason why is because we have all these aluminium producers and downstream businesses located in the GCC. Next to Andy, we have Hilmar Leimbach, who is currently CFO for GAMCO, the Gulf Aluminium Rolling Mill company located in Bahrain. Hilmar has over 20 years international experience in financial and operational management. Prior to joining GAMCO, he spent 2 years as an independent consultant in the aluminium industry and real estate management sector. Previously, Hilmar was Director of Finance and Business Planning for the Global Aerospace, Transport and Industry with Rio Tinto Alcan Engineered Products, which is now Constellium, located in Paris. Prior to this, he was the Director of Strategy and Management Reporting for Novelis Europe, and based in Zurich. During his career, he's embraced various roles at Alcan and Procter & Gamble. Hilmar is a graduate of the International Master's Program in Practicing Management from McGill University in Montreal. He holds a diploma, Kaufmann in Business Administration from the Justus Liebig University in Gießen, Germany. So welcome, Hilmar. Welcome, Andy. Let me just kick off on a couple of questions just to warm up the stage, give Andy and Hilmar a chance to give some thoughts. Hilmar, we have a lot of people from the audience who are from the upstream and downstream business in the GCC, as well as from other parts of the world. In your opinion, based on the experience you've had with Constellium, Novelis, and more recently GAMCO, on what basis do you think people should hedge, and when they should hedge, and what they should hedge? Just an overview of your experience on hedging.
Basically, my experience is that in the aluminium downstream industry, hedging is the kind of the general rule. The problem is that it gives the illusion that metal is neutral to your bottom line, but there's never a perfect hedging. Even if you have a hedge program like GAMCO, which is a combination of hedge, offset hedge and inventory hedge, you have all these kind of slippage. And because we have this kind of ideal hedging situation and program, there's little attention to all the things that can go wrong. So the principle is that we should be hedging. The question mark is who is basically the risk manager. In my experience, the problem is that typically you have one person who has the risk manager as a job title, but your frontline risk managers are your salespeople, your purchasing people, your operational people. If they are not knowledgeable about hedging, about the risk, basically you have a lot of trouble and with this illusion that metal is neutral to your bottom line. Also, another thing is that basically it's depending on your end customers. Some end customers are basically not, or the industry, they're not able or they're not willing to accept LME plus, be it that was the case in the aerospace business where they wanted to have firm fixed prices, where basically the response from the business was not basically, there was no explicit response to how do we hedge these type of customer or market behaviors. So it's a little bit like not every business model works like LME plus conversion, and even the best hedge program or hedge policy does not protect you from all the slippage that David was mentioning.
Thank you, Hilmar. Andy, maybe you can talk a bit about the constraints that maybe the producers or consumers finding their hedging programs. Being a broker, you must hear some anecdotal tales about people's business constraints in hedging. Can you insight on that?
Sure. Wow. Yeah, good morning, everyone. I guess looking at the question originally, a lot of questions in there in a short space of time, and easily the most common reason for hedging is to provide steadier returns in terms of being able to manage the business going forward, and also it's useful for your finance providers to have surety about returns and for your investors. So the main aim for most people, in my experience, is to keep a relatively steady return. Clearly there are some obstacles to the perfect hedge, and I guess the point I would make there is that it may well be much better to have an imperfect hedge than no hedge, because with not hedging in a lot of businesses, your income will be subject to huge fluctuations. For certain periods of time you may do much better, but that is not really relative to the performance of your business. And at other times where it becomes damaging, obviously you may be losing money where essentially you have a good business. So even though the hedge is not 100%, and I don't think any hedge is 100%, maybe there's one or two, but having 80 to 90% coverage of your risk to smooth the income is, I think, still preferable than not hedging.
Thank you, Andy. I'm conscious of the time. I know we said we'd finish at 12, but maybe we may go slightly over. I want to turn over to the audience now, because we didn't have a Q&A session of the presentations. So maybe we can take a couple of questions from the audience before I revert back to the stage with more questions. Any takers on questions? I'm sure there'll be some salespeople here who are guilty, as David said, of these things. Any questions from the salespeople in this room? Oh, no takers? Okay, so maybe I'll just throw some. Yes, we have a. If you could give your name and which company you're with, and then ask the question, we'll respond accordingly.
Greetings, everybody. This is Sunil Mardia from metalexes.com, India. We represent, or we are an association of about 18 to 20,000 members dealing in non-ferrous metals. And I understand everything, whatever you all have said, is that there are two things or two risks that we all need to take care of. One is the LME pricing, and secondly is the currency hedging, because the business has become global as of now, and we need to do that also. Now, I mean, the bigger companies will definitely have big consultants, or the banks and the consulting groups and all that, trying to guide them or tell them what should be done, when hedging should be done, and all that. What happens to the smaller companies? Because these smaller companies are good at manufacturing. They are good at doing their business. Now, this hedging is completely new. Maybe it is 5 years or 7 years or 10 years. I mean, how can things be simplified for smaller companies to take care of these two risks? I mean, we have understood a lot of things that we should do it, and how we should do it, that also we have understood. But the costs, I think, would be prohibitive or are a deterrent for the smaller companies. Can we have an answer to that? Or yes, how things can be made a little more simpler and a little more reasonable?
Yes, for sure. It's a good question, for sure, because not all hedging fits everybody the same way. And there is obviously a cost to hedging. Does anybody from the floor want to take this, or shall I? David?
I guess it's been the challenge of my life, so I'm glad to answer the question. Basically, there is a certain level of financial risk that you take, which if it's low enough, it's almost not possible to bring yourself up to be able to deal with it, because there are costs associated with both education and the actual action of hedging itself. But most companies who have a reasonable throughput and can quantify their risk in a reasonable way, but don't know how to do it, have to do two things. They have to, first of all, educate themselves, or three things. They have to educate themselves in how their business needs to be combined with a risk management approach. That's obviously the kind of business that my company does. We provide that kind of help and education. You need to be able to have counterparts who you can do your hedges with, be it banks for Forex and brokers for LME, and you need to have relationships with those people which can practically carry out the hedges that you need to do. And thirdly, you need to have a system which will give you controls and visibility in managing that risk. As someone who's completely new to it, it's a foolish thing to try and just have your existing kind of account system or spreadsheet system cope with this. It needs more than that. And obviously all of this comes at a cost, and I'm the first to admit that you have to evaluate the cost of putting the right kind of system together, and if the risk that you are taking isn't worth that sort of initial cost, then you can't do it. But I've rarely encountered companies that I've done an audit for in terms of the exposure of the company without finding, first of all, that the amount of exposure is way, way more than the company ever believed was the case. And secondly, that exposure as compared with a reasonable program to try and manage it, that you weren't better off trying to manage it than just ignoring it. That's from 15 years worth of experience. There's not been a single instance where I've felt that my time was wasted working with companies.
Does that answer your question? Any other questions from the floor? Yes, the gentleman over there.
Hello, good afternoon. My name's Lawrence Hambling. I'm from Heineken in the Netherlands. I wanted to ask the panel a little bit more about the premiums. Obviously becomes quite an interesting relatively new aspect to the aluminium market. I understand everything on paper, all looks very nice. The regional aspect of it, we already have a premium on the CME, for example, that's very liquid, and actually it's about liquidity. So I understand the reference points. My concern is with these contracts is they become reference points with no liquidity. And how can we make sure that these type of contracts are actually adding some value? Because if they're just a reference point, then how does that help someone like me to manage my risk to the premium? Because in the end, maybe I'm the only one that wants to do something with that. So my question is more about, are these, it looks very nice on paper, but is it not a bit counterintuitive? You know, the problem has already happened. Now we're trying to fix the problem, and in the end, this premium might just become a very small aspect. It's now a very big aspect of the price. But so my question is it not a bit counterintuitive?
Maybe Oscar, you can take this one.
Absolutely. I completely agree with you that the important thing is to make sure that these reference prices have good liquidity, so that they really represent where the premium is in the market. What we are doing from the LME perspective is that we are very active in marketing and educating people about what the premium contracts are. That's why I'm here, for example. Then we will also have market makers, and we look to get both financial and physical players engaged in market makers and providing liquidity to the market. But I think ultimately it is, does the market want these contracts? Do people want to buy and sell the premium element of the aluminium price? And if that happens, then I think liquidity will form on the premium contracts. So one feedback point that we've taken from our sort of initial market engagement was to concentrate and only have a monthly contract rather than following our existing prompt date structure with the 90 or 3-month contract which is rolling, so that there is a price for, or there is a delivery point every day. These will be monthly deliveries, and that is to help concentrate and build up liquidity. And then, obviously, where does this sit together with the entire warehouse reform package? What's most important for the LME is to have a good reference price for the market. And obviously, the premium levels have been a significant problem. And that's a lot of feedback that we have received from the market, is that we need to address the premiums. And that's why we are both addressing the warehouse queue situation, and we're also introducing the premium contracts. And I guess the interesting question is then, what will happen once the queues are gone, even if that maybe takes 2 years, which it will take under the linked load-in, load-out rule, approximately, depending on load-in scenarios, etc., etc. Or if that can happen quicker, if we decide to go ahead with these the charge capping and the limit or ban rent in queue initiatives that we are potentially looking at. I've received a lot of feedback from people saying that even in a post-queue scenario, there will be demand for hedging your premium. Yeah, I think it's ultimately up to us to do whatever we can do to make sure that there is a price that people can trade, and then it's up to the market to want to use these contracts. And if we work together, we can create liquidity and a credible reference premium price.
Maybe I can be a bit more controversial or cynical at this juncture. I would much rather see an all-in price for aluminium or any commodity, rather than having a split between a price which is set in the second ring at the LME and the premiums, which is, from my point of view, used by the producers to cover their cash cost of production, as opposed to curtailing their production. It is going away from the market fundamentals. I would much rather see an all-in price, then it avoids any discussions on whether the premiums are going up or down, or whether the LME prices are up and down. To what extent can that happen, Oscar? Can the LME do something to say, okay, now, the premium is only going to be to get the metal from producer to destination. It's the freight cost. The all-in price is the commodity price. Then you don't have to hedge premiums, you don't have to hedge the LME, you do an all-in price hedge.
Yeah, I see your point, and I agree. It would have been much easier if we could have one price. But I think the reality is that there's a difference in supply and demand between different regions, different locations. So even though our global contract is the reference point, there will always be these premium elements, and it is sort of down to shipping ultimately, but it is relatively expensive to ship metal from, say, the US to Asia, and we thought a lot about how to try and construct the premium contract so that we would create something that complements our global contract rather than dilutes it and draws liquidity away from it, because we still believe in a global reference price. And that's why we created the premium contracts in the way we created it, which might look a little bit complicated, but that's where you trade the two contracts in parallel. By doing this, you will not dilute liquidity away from the global price, but you'll still be able to hedge the premium. But then I guess what we can do from an LME perspective is to publish what the all-in price is for, say, Europe. And that's just simply adding up the two prices together. And that is what we would like to become the new sort of reference point for the market.
Okay, so basically it's an all-in price by region is what we'll end up with, essentially, depending on the supply.
Exactly.
of metal.
But the way that's the way you see it, but the way you trade it,
yes,
when you look in the details, is you have two different contracts.
Exactly. So Andy, from your point of view as a broker, how easy or difficult is it going to be to manage these premium hedges?
I think it's always a catch-22 situation when a new contract gets launched. And obviously, when it's not there, there's no liquidity, and everybody needs to kind of believe there's going to be liquidity before they start trading. So I'm encouraged to hear there are going to be some market makers and hoping that they will automatically be providing that liquidity for whatever volume. How well that works, I think, is going to be key to whether the contract takes off. There's been enough interest expressed, I think, because of the premium situation over the last few years for companies to hedge that element. And so I think the interest is out there in the market. It very much depends how the contracts launch, and if everybody can get the prices with a reasonable spread for the premiums, I think it can take off. And I would obviously like to see it take off so that people get accuracy, more accuracy in their final prices. The issue being that the LME contract is seller's option in where to deliver, and in the old days where there were no queues, you could always take delivery somewhere, and then your maximum premium was going to be the cost to get it out and move it to where you actually wanted it. So you had some kind of a cap on things, but that obviously changed recently. So this would be a useful addition if it works from the offset, and I think it's a big confidence issue for the market to see it working from day one. I think there is appetite for it if people see it working.
Wonderful. Hilmar, from a producer or a downstream producer, are you getting anything from your customers on the risk management for premiums? Do they want to lock into premiums in their commercial prices?
Let's put it this way. Garmco has not established a very sophisticated way to sell products. So they still sell a metal plus conversion, which includes the premium, which is more, let's say, an internal, wake-up call for us to look for premiums, especially considering the volatility in the recent years. There will certainly be appetite to hedge in future, but we're happy right now that the premiums decrease because they are eating up a lot of our profitability, being fully exposed to it.
Yeah. Okay, let me turn back to the floor. Any other questions you'd like to pose to the panel? I'm just conscious of the time. It's now almost 12:10. I have one further question for all the panelists here, just to put you on the spot. What's your prediction on the 3-month LME price average for this year, and your oil price as well? Let's go for both. Where do you think the LME price will end up, and the oil price per barrel will end up? Oscar?
Well, I think as the exchange, I don't and should not have a view on this. And
Perfect.
so I'll pass that question on to David.
David?
How many currencies would you like? I mean, this is more a question.
Just in US dollars.
Well, US dollars is the most difficult thing to predict about because it's the factor which is, at the moment, it could go very strongly either way. Assuming that there is no great change in the US dollar, which is a huge assumption to make, I will make the guess that we will have a range of prices for the year which is no greater than the range that we saw last year. It's one of those side-by-side years. There will come a day when aluminium makes a move strongly in one direction, but I don't think it's going to be this year.
Okay. Hilmar?
I would also support David's opinion. I see it stagnating at the current price levels with no big volatility.
Andy?
Clearly, the prediction game is very difficult.
Yes.
What you say today, you may look a complete mug in 2 weeks' time, especially as we saw $100 up and down on aluminium last week. So to supplement my own thoughts, I did have a little look at research. The average of 35 professional analysts' view for the average price this year was going to be $18.78 for the whole year. Now, so far, it's averaged 18.05. So they're all clearly looking for an increase in prices for May through December, up to about 19.15, which is within the range that we've seen recently. I'm not quite so bullish, but I'm not far off of that. I've got a plump for something, and we'll look at mug in a couple of weeks probably. But I'm saying 18.70 for the whole year, 19.03 for the balance.
1903 is very precise. Thank you, Andy. Yeah. No, so I think you can see there's a lot of uncertainty in the marketplace based on the comments we've heard. This uncertainty increases the risk of cash flow certainty, increases the risk of profit margins. So that's the game we're in. We have to mitigate our risks. We have to understand our risks. I'd like to thank the panel for participating. I'd like to invite Arvind Kumar to the podium to close off on the workshop.
Thank you, Mr. Raj. Let's have a big round of applause for all the speakers and panelists today. Thank you so much for your presence and your time. It's much appreciated. On behalf of Gulf Extrusions, we've always been committed to educate, to inspire, and to bring knowledge forums like this to our customers and also to the industry. We thank you for your presence and patience, for being here. I hope you enjoyed the program. Before I let you go, we have a small token of appreciation for all the speakers today. May I invite Mr. Raj to give a small token of appreciation, starting with Mr. Oscar. Mr. Oscar from London Metal Exchange.
Thank you very much.
Thank you.
Thank you. Thank you very much.
Now, we'll invite Mr. David. Thank you so much, Mr. David, for being with us today. Mr. Hilma from the Gulf Aluminium Rolling Company. Thank you so much for being with us today. Mr. Andy Evans from the International FC Stone. Thank you so much for your presence, sir. And before we let Mr. Raj go, of course, he's been such a wonderful moderator today. A big thank you to Mr. Raj Navsaria.
So I'll return this back to you later.
Yeah. Once again, thank you all for being here today. Without you, this event would not have been a success. We're going to have this video recorded. We already recorded the video, of course, and we're going to be playing this up on the internet. Please feel free to share it with industry colleagues so that we continue spreading the awareness and education to the industry. Once again, thank you very much, and enjoy the rest of the conference, and of course, enjoy Dubai. Good afternoon.
Yeah. Thanks a lot. Thank you.